Yeah, hi there. It's January 27th, and this is my first video for 2020. Well, today the big news is the coronavirus in Wuhan and how that's impacting markets. As we speak, the Dow is down 445 points. Seems like a lot of points, but is actually only 1.5%. Markets have been really strong year to date based on many of the dynamics we've been talking about at the end of last year. Many of those things include strong macro. We got very strong housing data in the US, and if you look globally, the theme is really synchronized global upturn in economies. So if you look at things like the leading economic indicators globally, they are all turning up, which is actually quite good news. So let's look at this coronavirus in the context of markets. We learned from the SARS virus back in 2002. This was a pretty severe outbreak at that time. Obviously, the science that we had at our disposal, whether it's genomic sequencing or testing, wasn't as sophisticated as it was today. So if we remember that, the first case came out in November 16, 2002. The Chinese really had no idea what it was and how this virus was spreading so quickly. It wasn't really until February 14th, 2003, until the Chinese reported these cases to the World Health Organization, the WHO, and really then it wasn't really until March 21st that there was a real response. So really within 3 months of the SARS breakout in 2002, you had 13 countries that were involved with this virus, and you already had 10 deaths. So the interesting thing is, from a market point of view at that time, although it was very serious and it was in the news all the time, because we were already in a bear market, if you remember 2001, 2, 3, all 3 years were negative years in the stock market, there was really no market impact. So actually the bear market ended pretty much with the kind of plateau of cases that we saw out of SARS, and that was kind of the bear market in 2003 ended around March 14th, and then we had a pretty nice bull market after that. So the second coronavirus that we've been familiar with was MERS. That is MERS, and that stands for Middle East Respiratory Syndrome, which was also a coronavirus. Corona, actually the name corona comes from the scientific abbreviation. That's how they came up with the name Cordona. The first case of MERS was in Saudi Arabia, and that was in September of 2012. That was actually quite serious because the infection rates or the mortality rates were actually 35%, although there weren't as many cases as you saw in SARS or now with the Wuhan coronavirus. The mortality rate was actually quite high for MERS at 35%. So if you got MERS, and luckily there were only about 140 cases, 35% of the people died who got that coronavirus. So let's fast forward to today. The Wuhan coronavirus was first detected in December 31st, 2019. So the good news is the Chinese really acted very quickly. They sent the genetic material, which is RNA, to all the major labs around the world. And we already had a sequenced, so a genetically tested and sequenced version of that virus around the world in the labs by January 10. That was very, very quick. So we have the best minds right now working on trying to get something out to be able to cure this virus. So as of January 22nd, all these viruses are in the labs. And if you think of some of the companies that we own, for instance, like Thermo Fisher, they are very prominent in providing the diagnostic tools that are being used for testing all over China and also in the labs. So if we think about Mortality rates. So SARS, and we don't have a full picture yet with the Wuhan coronavirus because it just started. But if we think about worst case scenarios, when mortality rates that we saw in SARS, which was the biggest outbreak that we've seen in our more recent history, the mortality rates for people aged 24 and younger was 1% for SARS, 6% for the age group of 25 to 44, and really the mortality rates go up the older you get. So 45 to 64 age was 15%, and then if you were above 65 years of age, the mortality rate of SARS was actually above 50%. So it's pretty serious. So the good news here is that the science is advanced very quickly. So it is unlikely that the mortality rates will be as high as they were during SARS. Now the question is more, what is the economic impact on China? It's interesting to me that the city of Wuhan probably nobody's heard of. These are cities with more than 10 million people in it that we've never heard of. The economic part of this is that much of the manufacturing that is done in China is actually in that region. So if you think the equivalent of shutting down New York or Washington for 2 or 3 months, how that would impact our economy, so that is something we're watching very closely. So there are certain stocks that are impacted by this virus. These tend to be in the hospitality area. If we think about restaurants, Starbucks has a lot of exposure into China. That's actually their biggest growth market. So they've closed a lot of their stores in Wuhan and so forth. Disney, which is one of our stocks, they actually closed their park in Shanghai. It's farther away, but if you think about how problematic this is right now, we're in the middle of China's biggest holiday season, which is the New Year. Typically people tend to travel during that time. They obviously tend to visit parks like Disneyland. So that is shut down right now. Other stocks that we own that may have an impact are Alibaba. Alibaba is not really impacted on the ground. Even if you think about it, people may even shop online more than going to stores. But stocks like Baba are proxies for China, so a lot of hedge funds like to use that to short the macro conditions there. We continue to like Alibaba as a stock. It was one of our best performing stocks in the last year. But that's something where people are using that as a hedge to short China in the short term. So we've learned from some of the organizations, CDC and others, that it'll take quite a few months for this to peak. So if you listen to the scientists on this, the expectation is that April is sort of the peak. So this will be in the news for quite a few months. And we will be following very closely if it's being contained or not. Our expectation is that it's highly or more likely that this virus will be contained quicker than the SARS epidemic because we are just so much more advanced. And the policy response from the Chinese has been pretty dramatic. So I think the market was kind of looking for an excuse to sell off here. If we just turn to the market technicals, and I'll turn around the camera here in our low-tech environment. So if you just look at where we've come from in the last year in terms of the market, here's the sell-off right here that we had back in 2018, which kind of ruined the 2018 year with that big sell-off in December. But you can see the year here. You can see how extended the market got really out of the gate in 2020. So there was some expectation that we would fill this gap here, which is really the gap between the market's rise and the long-term moving average, which is the 200-day line. There was real expectation that should be closed at some point, this gap, for the market to go higher. So this virus outbreak is really one of those reasons. I think the market is pulling back. I mean, there are other things that have gone on since the beginning of the year that are certainly noteworthy. We have the impeachment trial going on, which seems to have no effect on the market so far. And also, if you remember, the military excursion in Iran, or the exchange of hostilities between Iran and the U.S., that also impacted the market for about a day. But once it was clear that that wasn't going to escalate, markets went higher after that. So our expectation is that, you're going to fill this gap here at some point with the market. So that's good news for us because we are still bullish in the market. We've gotten a lot of new money to invest from a lot of our clients that have missed a lot of the return. I mean, if you were fortunate enough to be long the market last year, you were up about 30%. Even balanced accounts were up around 20 or more. So many retail investors and many are actually chasing this market, which is not that great. But for us to put new money to work, we really want to see the market come down a bit. We don't think this is a good time to put new money to work, but it's actually a good time to rebalance accounts. A lot of our balanced accounts, we've been pulling back very large positions in technology stocks. These include actually some of our favorites like Microsoft and Adobe. And we're really rebalancing the accounts into stocks in themes or in areas where we think there's a lot of upside. And areas that are included in that are, if you look at 5G, I mean, there's been a lot of talk about Apple stock here and a super cycle in 5G phones. If you think about the next year, basically probably everyone is going to be shifting to a 5G enabled phone into 2021. The iPhone today does not have any 5G capabilities, so we think the upgrade cycle of the iPhone will be very strong going forward. There are other beneficiaries of 5G that we're really interested in that we already own: American Tower, Crown Castle. The nice thing with these stocks, they actually have very nice defensive characteristics, especially in this type of market. If I look at where our stocks are today, actually the stocks that are up today are in that area. American Tower is actually in the green today, and gold is up today, and things like NextEra, which is a utility stock that we own as well. So the other area that we're looking to add and have added this year already is in cyber defense and security. We added L3 Harris to the portfolio just recently. This is a merger of two very high quality companies, L3 and Harris. They are in the defense sector, but a lot of it has to do with cyber security and defense logistics. Think of it as the company that's doing digital transformation in the defense sector. So there's a lot of emphasis in all of our companies in digital today, and L3 Harris is the one that's really getting the defense sector in that direction as well. So that's really it. So our conclusion here is be patient, don't panic. It's actually a good time to put new money to work once the technicals settle, and we will continue to watch the impact of this virus on the Chinese economy. The last data point that we got out of China was actually a pretty good one. The Chinese economy is at about 6%, and if you think of all the tariff warfare that we had, and now the signing of phase one, we think that takes some of the pressure off of the Chinese economy as well on the tariff side. So we don't expect any bad news there from the macro side. On the US side, the pattern of GDP growth, if we go to look at fourth quarter, so the fourth quarter is about at 2% of last year. So the fourth quarter of last year was at about 2% GDP. We see that rising in the first quarter or second quarter to about 2.5 or 2.7. So going into 2020, we have a tailwind on the macro side. That was something that was very different going into 2019, when the economy was actually slowing going into 2019. And that's the reason we got this response from the Fed and when they lowered all those rates. So that's it for us. See you next month.